Hello, and thank you for joining today's Family Office Network's webinar series featuring Emerald Park Capital. Presenting for us today is Joel Magerman, Managing Partner of Emerald Park Capital. Emerald Park is an affiliate of Bryant Park Capital, a middle market investment bank that services both the cannabis and traditional sectors. Joel has been the CEO and majority owner for close to 20 years. During his career, he has been involved in closing over 150 transactions as principal, investment banker, and investor, representing a total transaction value in excess of $6 billion. At the end of today's presentation, we will have time for Q&A. Please use your questions chat option on your screen to send over any questions you have so we can answer them accordingly. And with that said, Joel, I will let you take it from here.
Great. Thanks, Lindsay. As Lindsay mentioned, I'm Joel Magerman, Managing Partner of Emerald Park Capital. Good afternoon. It still does take a little getting used to not doing this in person, but unfortunately is a sign of the times, and I do appreciate everybody participating today. I also wanted to thank Andrew, Peter, and Lindsay and their team at Family Office Network for setting this all up. Today, I'm going to talk to everybody about the cannabis industry in very broad strokes, and in particular about the environment and the opportunity set as we see it today. Emerald Park is a credit-focused private equity fund focused exclusively on providing debt in the cannabis industry. We formed Emerald Park in mid-2019 when I realized that the cannabis sector really represented one of the most unique investment opportunities that I had encountered in my 30+ years of investing and advising hundreds of companies across numerous industries. Your normal disclaimer pages. As I mentioned, Emerald Park is focused on providing senior secured debt and structured equity. To date, we have made 5 loans and have an active pipeline of new investment opportunities. Like almost every business, it's about the people, and we feel like we've assembled a really great team with broad experience. More recently, as Lindsay mentioned, I have close to 20 years experience as the owner and operator of Bryant Park Capital, a middle market investment bank, where my partners and I have completed over 300 transactions in excess of $35 billion in value. My partner, Brooke Hayes, was the COO at Milestone Partners, a private equity firm that deployed over $700 million over his 15 years. And prior to that, he was an investment banker at JP Morgan. The rest of our team also includes a group of successful operators and professional investors over the course of their career who have done a significant number of transactions. In addition to their general business experience, our team has also closed over 60 cannabis transactions over the past 5 years, including obtaining over 20 cannabis licenses. What I wanted to do is provide you a quick overview of the US cannabis landscape. Today, cannabis is legal in 38 states, including 5 states that recently passed legislation during this past election cycle. That includes Arizona, New Jersey, Montana, South Dakota, and Mississippi. Of those 38, 15 of those are legal for adult usage and 23 for medical usage. As you probably hear from reading the press, cannabis legalization is really accelerating both nationwide as well as internationally. And this growth is really driven by a combination of new legislation passing, consumer adoption, expanded capacity, a conversion from both the illicit market to the legal market, but also taking market share from other areas like beer, wine, and spirits. In the US, if you look at the bottom right chart, what you'll see is that the overall industry has grown from about $12 billion in 2019 to what's expected to be $34+ billion in 2024, a compounded annual growth rate exceeding 19%. These 2 charts here show how the cannabis industry compares to other industries and its acceptance. The top chart on the left shows the 2 light green bars, the legal cannabis and the illicit cannabis market. legal cannabis market in 2020 is approximately $17 billion. In combination with the illicit market, the market in fact is larger than the overall tobacco market in the US. However, the growth rate is significantly greater. In addition, if you look at the demographics finds acceptance across sort of all age groups, whether it be millennials, Gen X, or baby boomers. And from surveys that have been done over the last 50 years, we're now at the point where 90% of Americans support legalization of medical marijuana, and 2/3 of the population approve it as recreational usage. In addition, legalization is also supported by a lot of research in the sector. Today, there are over 113 identified cannabinoids, and the most well-known ones are names you're familiar with: THC, CBD, and maybe CBN. And if you look at the top 3 usage for cannabis, they really are things that people deal with every day: chronic pain, sleep and relaxation, stress and anxiety. While our focus is not on the pharmaceutical side of the world, it is important to point out that there's a significant amount of work being done in this space, and there are 4 approved drugs that are derivatives of cannabis. One, Epidiolex, which is used to treat seizures and epilepsy, as you may have heard about. Marinol and Syndros, which are approved to treat nausea and vomiting for cancer patients getting chemotherapy treatment. And the 4th is a drug to treat loss of appetite and weight loss for people with HIV and AIDS. Today, numerous top-tier research institutions around the world have fully staffed labs that are using cannabis and its derivatives to develop new drugs and applications. The prior pages provided you a sort of a high-level flyby of what the macro industry trends and demographics look like. It's important to understand that during this time frame, there was a transition from what I would define as Cannabis 1.0, which was, call it pre-2018 through late 2019, and to where we're heading, which is we're heading to expanding in Cannabis 2.0. This slide is really representative of the Cannabis 1.0 mindset. What this shows is the top 18 US multi-state operators, MSOs, and the geographic areas in which they own assets. So you'll see all the green dots represent states in which those top 18 companies operate. It does not include 1 or 2 dozen private MSOs that also do this. And what Cannabis 1.0 really represented was a first-to-market concept and essentially a land grab. Companies really were aggregating assets across numerous states as quickly as possible, often paying premium prices for either the real estate, the equipment, or services in order to have this footprint. This geographic growth was fueled to a large extent by the demand from Canadian retail investors. And that excitement drove up valuations, but it also didn't provide the financial results as quickly as many of these folks had hoped for. And because there was a lack of a real broad progress towards positive EBITDA, coupled with really no institutional view on valuation and a rationalization of values, the market started getting rattled in mid to late 2019. And there was a major sell-off in the second half of 2019 in these markets. In fact, overall, the top 150 public companies in the space lost more than 40% of their market value. Many of these companies really didn't have the management depth or breadth to execute on all these geographic expansions, and it caused uncertainty and concern in the marketplace. This led to a significant reduction in capital and a rationalization of business models. And what it did was force companies to think about how to right-size their operations, how to focus on delivering results, or if they didn't do that, to risk near loss or total loss of value. And by example, on this list, companies like Tilt and MedMen and Ianthus are examples of some of those missteps. Transitioning to Cannabis 2.0, the new focus is really on operational execution and really starts in the end of 2019 and early 2020 is really continuing today. Smarter operators realized that they didn't have access to unlimited capital and unlimited time to deliver results. their focus needed to change. They needed to go from growth at all costs to right-sizing their business model and getting EBITDA positive. They realized they had to be one of the top 3 to 5 players in any given geography they operated in, as opposed to being as in many states as they humanly could cover. As a result of this, capital was effectively restricted due to a shortage of supply, and it restricted many companies from going to the next steps. And the only companies that really got capital were ones that were good stewards of capital and can achieve operational excellence. So if you look at this graph, what you see is in Q3 of 2019, the top 25 US cannabis companies had about $60+ million of negative EBITDA. Fast forward 12 months later to Q3 of 2020, they're now $225 million of positive EBITDA, 280% increase. And what happened with this trend is it really is at the early stages of driving meaningful M&A activity. The smaller companies and the ones that are not performing well are distressed. They don't have capital that they need to support their business plan. So they're going to be forced to divest of their licenses or properties in states where they don't have the resources to compete effectively. And the companies that are performing well and have been able to raise capital, they're really looking to pick up these assets to bolster their supply chain, increase margins, and leverage both their brand and their operations. What Cannabis 2.0 really looks like is leading to a more attractive pool of investment opportunities, really predicated on the traditional value drivers that investors normally think about: transparency, cash flow, operational excellence, and the ability to have year-over-year organic growth. As you might have seen when you look at the timeline here, a lot of this was happening right in the middle of COVID. And obviously there was a huge concern that that would actually hurt these companies, but in fact, it actually helped. If you look at this shift from Cannabis 1.0 to 2.0, what happened with COVID in the middle is cannabis was deemed an essential business designation in every jurisdiction in which cannabis was legal. And the social distancing aspect of this actually caused the regulators to change their e-commerce regulations that allowed people to utilize pickup and delivery where before that may not have been available in that state. It also accelerated consumer adoption for alternatives like alcohol because it was deemed essential. And so what you see on the bottom left-hand chart is you see a analysis of the same-day sales changes from January and February pre-COVID to what they look like in the end of March through April. And what you'll see is the lowest increase was 5% increase in sales, the highest at 35%, and the average about a 20 to 25% increase in sales over what was happening pre-COVID. And what you see in the right-hand box is if you look at the overall revenue growth in the market from Q1 2019 to Q3 2020, you'll see a significant growth from approximately $300 million for the top 25 companies to close to $1 billion, with the red dotted line indicating where COVID was and the continual growth both through and after COVID. As the market continued to grow, what was becoming apparent was supply was having a hard time keeping up with demand on the cannabis side. And so despite all the capacity that was built by a number of market players, demand was still being outstripped in the legal market. So if you look at this chart, it's although there's a lot of boxes, you can ignore most of the noise. What it shows is sales in September, the wholesale sale price of cannabis in September compared to October and what the growth rate is. The top yellow box shows that the overall market had a 3% increase in wholesale pricing. And that happened in the face of increased demand that was unable to be met in many cases. And in fact, even though there's a concern about long-term shrinking margins resulting from price compression as the cannabis markets mature, by example, the second yellow box shows Colorado, which has been the nation's most mature and longest legal cannabis market. It's been in place for over a decade, and their wholesale price increased 13% from September to October. So there's just a ton of demand that's happening out there and needs to continue to be fulfilled. As we talk about market growth and the shortage of capital and the coming M&A consolidation, this really page is an example of what consolidation will probably look like. And by example, we've looked at global market share for beers. On the top right-hand corner, you'll see a lot of beer companies and beer bottles. The line on the left, it represents Anheuser-Busch InBev, and on the right, SAB Miller. And if you look at the pie charts from 2003 to 2019, what you'll see is the dark green pie slice. That's Anheuser-Busch. And that went in 2003 from about a 9% market share to in 2019, close to a 30% market share, more than a 3 times growth. In addition, you'll see this dark green box on the left. You'll see that that's all other, and all other went from 57% of the market in 2003 to in 2019 to 29%. So this consolidation is out there, it's happening. It happens in virtually every industry, and we're in the very early stages of seeing this in the cannabis market. But there are also other forces that are driving growth, and part of it is the implications of potential tax revenue and job creation. What this slide shows is that the cannabis market has the ability to contribute significant amount of jobs and significant tax revenue. By 2024, over 500,000 jobs will be created, and the tax revenue will generate over $24 billion, with the economic impact exceeding $130 billion. And that doesn't assume full federal legalization. On the chart on the right, what you'll see is that 522,000 jobs created in full legalization would actually represent 1.6 million jobs. And as this election cycle saw 5 new states passing legislation, additional states are queuing up for further approvals. And as COVID really elevated the focus on cannabis, every state ended up deeming cannabis essential. It really looks like it has an opportunity to have a meaningful impact for our economy over a long term and drive what's happening in the business. Additionally, there's legislative activity and regulatory activity happening in the market today. There are 66 actually bills in one way, shape, or form that have been constructed. The 3 most prominent are the Safe Banking Act, the States Act, and the MORE Act. As you see on the table on the right, the check boxes, they have a lot of things that are similar. Obviously, each one has things that are a little bit different and more stringent. It's likely, or the thought is, that at least one of these will get passed in 2020, although there is a vote for the MORE Act tomorrow in Congress. It probably will pass Congress, but unlikely to get through the Senate this year. But really what these bills do is they allow cannabis companies more readily to have access to the banking system and traditional financial services, increase capital market activity and accessibility. It should allow companies to uplist to major exchanges, and in many cases, it should reduce some of the very burdensome tax treatment that these companies are getting. So on the tax treatment side, if one or more of these bills are passed, it will potentially provide tax relief for the companies here. So if you look at this, there's a law on the books for cannabis companies and other companies that operate in controlled substances that they have to pay taxes on their gross margin. So it's only the cost of goods sold are deducted. And so as a result, if you look on the top right-hand side, Trulieve and Green Thumb are 2 of the larger players in the cannabis sector. Their effective tax rates are 82%, the light green bar, and 73%. However, if you look on the bottom of the page, what you'll see is traditional consumer CPG companies like Lowe's, Dollar General, Dunkin' Donuts, Brown-Forman, Kraft Heinz. The dark green bars are what their effective tax rates are, somewhere between 19 and call it low 30%. Well, if you apply the traditional tax treatment to Trulieve and Green Thumb, they would reduce by 2/3 their tax burden. And so, for example, Trulieve will do $400 million in EBITDA in 2021, and Green Thumb approximately $350 million. You can imagine that saving 2/3 of those taxes would significantly enhance cash flow to the business and probably have a meaningful impact on share price. So in summary, if you say, what are the takeaways overall from the market? I think the takeaways are that, number one, the cannabis industry has very strong momentum. The leading companies in the space have really figured out that they needed to right size and operationalize their business in a rational way. And they've developed performance that has gotten the market excited. They have proven through COVID, in fact, that their business model is essential in every state where it's legal. And these 38 states currently today are seeing significantly more states that are heading towards regulatory approval and are moving from medical to adult use. In fact, nationwide today, demand continues to outstrip supply, and the number of consumers continue to increase significantly. We think this is very encouraging, not only for the industries and the business, but for the overall economy and the ability to create jobs and generate tax revenue. So moving along, all the overall trends are very positive for the industry. But in order to go to the next step, the industry requires capital. If you look at the top left graph, what you'll see is that almost all companies in the sector say that they are either currently seeking or intend to seek capital in the near term. However, there remains a significant shortage of capital in the sector. This gap has continued to widen over the past year, and that's to a large extent based on two things. Number one, the lack of confidence in the industry, this Cannabis 1.0 mindset still. And number two, the lack of capital from other investing sources. Today, the Canadian retail market has dried up to some extent. The supply-demand imbalance is significant. And aside from a few funds like ours, high net worth individuals and family offices, there remains a big shortage of capital. If you look in the bottom right chart, what you'll see is in the light green bars, the first half of capital inflows to the cannabis industry, and the dark green bars, and that's in 2019, and the dark green bars in the second half in 2020. You'll see a significant decrease in public company capital inflows, private companies, and overall a decrease by 2/3 in the capital available to these companies. In addition, if you look at this, breaking it down by number of transactions and by different types of capital, equity, debt, or in aggregate, the fact that there's so much less capital available means that many of the small players have to compete with the larger players, and often unsuccessfully. This lack of available capital and the competition has really caused the movement from initially equity in COVID 1.0 to today, to a large extent, more debt, and seeing these investments move up the balance sheet, where investors get the protection of not only debt, often being senior secured, getting returns in the mid-teens with current pay interest, and often with equity incentives like warrants or those kinds of things. And from where we sit today and from what we know, it looks like this trend is probably going to continue for the next 12 to 18 months. And while raising capital in the markets has been challenging, the larger successful companies have actually been able to raise it, or had some on their balance sheet and raised it before. And actually they're performing today. If you remember the chart that showed some of the other changes on the EBITDA side. So the successful companies really have streamlined their operations. They've continued to grow at significant rates. And as a result, their shares have performed. If you look at this graph, what you'll see is the light green line is a number of indices, but the light green line is the US cannabis index compared to a number of other indices. And what you'll see is they've outperformed many of these other industries, despite going down and a big drop initially with COVID, it's performed incredibly well against many other industries and against their Canadian counterparts. Another example of this is if you look at the comparison of the top 25 U.S. multi-state operators versus the Canadian counterparts and what their combined total market cap is. If you look at late July in 2019, you'll see that the U.S. operators' total combined market cap was about $11 billion, compared to about $34 billion for their Canadian counterparts, where they're legal, and they have been fully legal there. Fast forward to effectively November 1st, and you'll see that the U.S. has almost doubled from 11 to 19, while the Canadian valuation has dropped by more than 50% to $14 billion. Now, anybody who follows U.S. Canadian market size, the U.S. is generally deemed to be 10 times because we have about 10 times the population of them. If you believe that to be true, that would imply a market cap of overall market value of probably $140 billion for U.S. companies, where today it's significantly below that. At this stage, the U.S. companies are really in driving and leading the market. However, this, as I mentioned, this shortage of capital remains, and really what that means for both us as a fund, as well as other investors, but certainly as us as a fund, is we've really been able to invest in companies that are not only top decile companies, but in many cases top 5 or 10 companies in the United States and even globally. Because of this lack of capital, we've been able to do it virtually all in debt instruments, and many of those debt instruments are senior secured. And what's being clearly seen today is that there's going to be winners and there's going to be losers out there, and there's going to be a lot more losers than people really want to recognize. And so being able to be in a place in the market to invest in a senior secured instrument with yields in the mid-teens and healthy warrant coverage is really providing for us and other investors great risk-adjusted returns. And we think that this has really supported both our investment thesis, and quite frankly, it has proven it's important in the economy through this disruption that we've seen through COVID. A good example of this is just taking a quick look at some of the top 25 U.S. MSOs that have raised debt, over the last 6 months or so. And what you'll see is virtually all of these players have raised debt with low teens interest rate, meaningful warrant coverage, and again, sort of supporting the thesis that we've just been discussing. While we've discussed the cannabis industry so far, it's been a bit in a vacuum. I think it's helpful to sort of try to put it in perspective and compare the cannabis opportunity to other industries. I think these 2 slides do a good job of really showing what the upside and growth opportunity is. So if you look at the chart on the left-hand side, the North American industry, on the left-hand side is the contribution margin as a percentage for all these companies in these industries, and on the bottom x-axis is the EBITDA dollar growth as a percentage of enterprise value between 19 to 21. And what you'll see is the red boxes is the cannabis industry. Their contribution margin is, a little higher than average, but their EBITDA growth is 3rd highest out of 125 industries, growing faster than virtually every industry out there, even though their contribution margin, and not even though, with a contribution margin that's still high. If you look on the right-hand side, in some ways even more compelling, is on the left-hand side is the enterprise value to EBITDA multiple that industries trade at, and at the same time, what their compounded annual growth rate is from 19 to 21. And what you'll see is the red box is the cannabis companies are a huge outlier. They're growing at close to 100% rate, even though their EBITDA, enterprise value to EBITDA, is actually less than the vast majority of these industries. Following on to this, if you look at the overall industry of consumer industry margins that are out there versus valuations, what you see is cannabis, and the dots are relative to size of the industry. You'll see the cannabis trades at less than 10 times enterprise value to EBITDA. Their margins are over 30%, which are very high, but they're lower than virtually everybody else in the market. Their enterprise EBITDA valuation is significantly lower than the rest of these other markets, even though they're performing at incredibly high levels. Although the market opportunity alone for growth is big, the other way of thinking about this from a long-term perspective is what the total addressable market is. And today it's estimated to be about $100 billion addressable market over the next 10 years. But if you actually sort of think about it in addition, as it relates to market size, with the EBITDA margins of around 20% or more and consumer packaged goods EBITDA multiples of about 15 times, if you applied that to the cannabis industry today, which if you took all of North America, the public and private companies, the probably combined market value is probably $50 billion, you're probably looking at a $300 billion opportunity over the next 5 to 10 years. That 6 times number is huge for almost any industry, but I think it's weighted towards the bigger players and the bigger players that'll be more successful. The smaller players will have a hard time getting that 6 times capture. So a larger percentage of this will be going to the larger players who we think are really looking at an 8 to 10 times market opportunity growth. Sorry, I just need a quick sip here. Moving along, I thought at this stage I'd shift a little bit and talk about our fund. I think you have a little bit of a background, although a very fast one, to the industry, the growth parameters, the scarcity of capital, and the valuation upside opportunities. Our fund is really focused on senior secured debt as the majority of our investments, and debt and debt-like instruments probably representing 75% of our investments. We do think that we'll be able to generate 25 to 30% plus IRRs on senior secured debt. And we do also reserve the opportunity to make some opportunistic equity investments in many cases alongside of our debt investments. Traditionally, the types of terms that we're getting in the marketplace and the way we sort of think about it is we're looking for 10 to 15% current yields on our senior secured debt. In many cases, the loans have upfront fees or OID or original issue discount, which is effectively like a zero coupon loan. The term is traditionally short, 2 to 4 years. In many cases, we're trying to get amortization so that the principal is being repaid during the course of the loan. Most importantly, collateral coverage is a big deal, obviously, to us. In all cases, our loan to values are less than 50%, and many cases significantly lower than that. We'll show some examples of that shortly. The collateral coverage is almost always first priority liens, including many of the liens against the equity of many of the company's subsidiaries, their licenses, their inventory, their receivables, most of their assets. In addition, we also have an upside kicker, right? In almost every instance, we have warrant coverage, and in many cases, that alone allows us to double or maybe even triple the current pay coupon that we get during the course of the loan. I thought at this point in time, I'd just give you a couple quick examples of some of the companies that we've provided capital to. The first one is Columbia Care. Columbia Care is a top 5 or 7 US operator. Today, they actually have a $1.1 billion market cap. When we invested, it was around $700 million. The company is expected to do about $464 or $465 million in revenue next year. The business, we made 2 investments in this company: a senior secured loan with current pay yield of 13%, Our loan to value on this is below 20%, and we have a senior position on substantially all the assets of the business as well as the enterprise. And significant upside potential with 25% warrant coverage. Today, the stock's up close to 100% from when we invested a number of months ago. In addition, we did a convertible debt investment in this as well. That has a current yield of 5% and allows us to convert at equity. Again, that equity is significantly in the money today. Another good example is Jushi. Jushi is, again, another top 10 public company in the space. Jushi has a market cap of about $440 million today. Their estimated revenue in 2021 is over $210 million. They should do about $45 million in EBITDA. We have attractive yield of 10% current pay on this transaction. In some ways, more attractive is at the upside we have on the warrants. We have 75% warrant coverage at $1.25 a share. Today, actually, the shares are trading over $4 a share. So that's a terrific outcome so far. Flower One is another example. They're has one of the largest operating grow facilities in the nation, 450,000 square foot facility that they invested about $110 million in. We were part of a group that provided $30 million loan against that, not only that whole facility, but all the company's licenses and other assets. We have a first lien against the mortgage. We're getting approximately 12.5% current pay, as well as good warrant coverage. The loan to value on a most recent valuation is less than 30%. Our most recent last investment was a company called NorCal. It is one of the largest vertically integrated players out in California. One of the top 2 or 3 players ranked by BDS. We have a convertible note that pays both accrued interest, has a strong liquidation preference, has a 3-year term and a terrific valuation, and with warrants as well. We're very excited about that opportunity. To give you sort of a quick review of the fund overall, we've seen approximately 515 deals since late 2019. Approximately 22% of those we've done due diligence on, and we've closed 5. All the ones that we closed were senior secured loans or convertible loans with mid-teen current pay and healthy warrant coverage and equity package. From a structuring perspective, you'll see the deals that we've seen. So you'll see 43% of those are senior secured debt, 34 structured equity, and a smaller portion opportunistic equity. And then you'll see on the right-hand side the sectors in which we've seen those. And we have a full-blown database that tracks sort of every activity that we have. This is a quick overview summary of the third-party providers that we use, our accountants, attorneys, third-party administrators in the bottom right. And again, just a quick overview of both the affiliation and our ability to utilize resources at Bryant Park Capital level, and at the same time have significant experience with our operating partners and the partners within the fund, and the ability to provide the full suite of things that you need to operate a business like ours. Internal accounting, human resources, investor relations, administration. Lastly, the summary term sheet for the fund is we're raising, targeting to close around $100 million plus. The general partner and our partners have committed, actually it's over $2.5 million. Our offering period extends through the end of March of 2021, and we have the ability to draw capital for 3 years and then have a full 5 additional years with 2 one-year extensions if necessary to harvest our investments. Although we do think, because they're on average 2 to 4 year loans, we'll get the money back much more quickly. The fees are traditional 2 and 20 European style, 80% preferred return to the investors, 100% of the capital goes to the investors until they get their money back and an 8% preferred return. That's quick the quick overview of the fund. I wanted to thank everybody for their time and patience today. I know we went through this really quickly. I think we left enough time to answer anybody's questions, but I appreciate your time and patience today. I know it's a little more complicated on Zoom, so thank you or on a webinar, so thank you for your time.
Hey, Joel, thank you so very much. Great job. To all of our attendees, yes, we would love to open it up for Q&A. So again, using your questions chat option, submit those questions on over so we can have Joel answer them. With that said, Joel, I'm going to jump right into the questions that we have so far. Let's see, question 1. It looks like the stocks in this sector have been rising. How does that affect the industry and your investment thesis?
Well, look, the nice thing is the stocks are rising because the companies are performing. In Cannabis 1.0, they were not performing, and the stocks initially were overinflated. There was a crash basically in the industry. They've come back up. They've come back up because companies are performing. If companies are performing, that's a good thing. If they're attracting attention on the investment side from traditional retail investors, that's great. I think it only supports our thesis out there, and the competition and need for capital is so great that I don't think it hurts us. It just draws attention to the fact that people are looking at valuations, they understand them, and they're willing to support them in the market. I think it's good.
Fantastic, thank you. Moving on, next question. What are the lending parameters you use in making credit decisions, and can you give us some examples?
Sure, so, you know, we use a number of different parameters based on the type of company and one based on the security. As I mentioned earlier, really, we're looking for loan to value in below 50%. In almost all instances, depending on where the company is on generating EBITDA, we're also going to look at, you know, debt to EBITDA multiples and those types of things. And again, on the assets that we lend against, depending on the liquidity of the asset, will change, you know, the percentage we'll lend against them. So, you know, inventory and accounts receivable, you generally think differently than if you're lending against either real estate or if you're lending against licenses. And so we are in a time right now where there's such a shortage of capital that in many instances where our leverage ratios are significantly less than they are in the ordinary middle market.
Great, thanks. Next question, do you invest in projects outside of the US?
So we can only invest in companies domiciled in North America, US and Canada. If a US company owns assets outside the US, we can invest in that US entity. We cannot invest in companies that are exclusively domiciled outside North America.
Perfect, great. Next question, is the interest payment due to Emerald Park including or excluding from the high gross margin tax rate? In other words, with limited cash flow due to high taxes, how can companies afford 13%?
It's a good question. Most of these companies, you know, that we're doing business with are bigger, they're more profitable. In many cases, they have cash reserves that are required to be on their balance sheet to make sure they can make interest payments either until they get EBITDA positive or once they're EBITDA positive. But the vast majority of the ones that we're financing, even though they can't deduct it, their gross margins are between 50 and 70%. Their EBITDA margins are often between 20 and 30%. So even though the tax burden is high, they still do have the cash to pay us. And we put it through a 3-statement model. We model out these companies. We look at their cash flow. Obviously, we're not going to finance somebody if we don't think they can pay our interest.
Right. Okay, great. Next question. Of the 100 deals that have entered due diligence but did not get invested, what were the common reasons to pass? Let's see. Or asked any other way, that were the special qualities of the 5 investments?
Again, a good question. I would say a lot of them were too early. We don't we're not going to take on equity risk with debt-like returns. We're not going to use debt instrument, even though it may be senior secured, to finance something that we consider a raw startup, and we don't have proof of concept. So that's one of the big reasons we pass. The other part is we get through due diligence, and whether it is the economics don't match what we think is appropriate, whether there's not enough security interest, and one of the key things, we really want to finance someone who we think will be a top 3, maybe top 5 player in their state. If they can't be a top player, we think that they run the risk of being one of the losers in the space. And we're really trying to finance winners. We want strong management teams. We want differentiated business plans. And if they're not going to be a top 3 or 5 player, we don't want to be in a position where they can't sell when it's time to sell, or if they have to sell, it's at commodity pricing or below. We want someone that will command a premium because they're a top player, and that's really where we're focusing our capital and our efforts.
Great, thanks, Joel. Next question, which I think is a good one here. It says, I've heard that banking is a major issue in this space. How big of a deal is that? And is it an issue for potential investors?
You know, another good question, and it's the overall industry. Banking is somewhat of an issue. It's not an issue for the companies that we do business with. All of the larger players have the traditional banking that we're used to seeing. They have, you know, the ability to send wires and receive wires. They have the ability to put money into accounts and utilize the accounts the way we would expect them to be used. We have the ability to secure our loan with what's called a DACA, a deposit account control agreement. Many of the smaller players, they don't have that. Many of them don't have access to traditional banks. So it will help the overall industry. It will give them access to more financial services. It will lower their cost of banking, and all of that is good. But there's no one we do business with who doesn't have the type of banking you would expect of a middle market company.
Great. Next question. Do you invest in small companies? And if so, what's the minimum revenue required?
So we don't have a written piece of paper that says if it doesn't cross this threshold of dollars, we don't invest. But back to what I said earlier, there would have to be a very compelling reason for us to invest in a smaller and/or / earlier stage business. We're providing senior secured debt. We're looking to get great risk-adjusted returns. Those returns in a middle market non-cannabis company would traditionally be, you know, 5 to 12%, depending on the type of debt, real estate or mezzanine debt. We're looking to get 2 to 4 times that return, but not taking any more risk. If you're providing that capital to much smaller companies, there's greater risk. And so for us, it would have to be an incredibly compelling reason to do it, but there is no dollar number that has a floor for us. It just has to be a really strong reason to do something that is the early stage.
Perfect, fair enough. Let's see, next question. If some of these regulations do pass and more institutional capital can enter the space, how will that change the outlook for the fund?
Look, I think there's so much capital that's required. You saw how much less capital has been provided to the industry. There's a huge need today, and there's going to be a continually huge need. You can't have an industry that grows 8 to 10 times without capital. Every company needs it, number one. Number two, even as institutional capital comes into this, it's not going to happen overnight. It's a 12 to 18 month period and process. People need to get comfortable with the cannabis rules and regulations which are at the state level, when almost all lenders today are focused on lending and the implications of federal protections in the federal level. That being said, additional capital will actually probably be helpful to us, because today we can't put any back leverage on the fund. And even if we use some conservative back leverage because additional capital was available to us, it would actually allow us to give our investors higher returns. So even if there was some downward pressure on pricing, we still think that we could maintain the expected returns that we have based on where the market is today and based on us being able to offer a more competitive product, but getting better returns.
Perfect, thank you. Next question, what is the minimum amount of money that you will accept from investors who are interested in your fund?
So as many of you may or may not know, there's usually a limit to 99 investors. Our fund has a minimum, which is a $500,000 today. But that's not drawn down right away. It's drawn down over the course of a 3-year period. So it's not like someone's writing us a check for that today. So, but that is our stated minimum. We do have some flexibility, but that's our stated minimum.
Thank you. And let's see, how do you access collateral in a downside scenario if there is no bankruptcy process available?
That's a great question. So before we even got into the space, we obviously, I shouldn't say obviously, we did a lot of work in that. We actually contracted with a law firm at the time to look at the short answer is you can't rely on the federal bankruptcy protection. And so you really need to rely on the state creditors' rights. So we researched at the time the top 16 states and what the creditor rights were in each one of those states and what it took to effectuate being able to perfect your collateral and take your collateral in the event of a default. Every time we do a transaction, we review what's happened in that state, how that works, and of course hire counsel that has significant experience not only in traditional lending but also in cannabis regulations so that we understand how to perfect that. And so, for example, there are certain states that are more or less difficult. Prior to about a year ago, Colorado wouldn't let a business be owned by someone who was not a Colorado resident, the majority owned by a Colorado resident. So you had to be very careful if you did something, by example, in Colorado. There are similar states that have those types of requirements, but you have to look at that. What I will say is, in many cases, state creditor rights are actually faster and in many ways better than federal bankruptcy. It's not true of every state, but it is true in many states, and it's something we pay close attention to.
Perfect. Thanks, Joel. Next question. How are you generating the prospects in your pipeline?
Well, multiple ways. Number one, there's only a very small number of funds in the space. So it's easier to get your name out there, sort of number one. Number two, as I mentioned earlier, I own an investment bank that also operates in the space. So people are often coming to us either as a fund, in many instances, or also as a banker. Number three, we have operating partners, as I mentioned, that have done 60 transactions in the space. They're all very active. They see many deals and they share those deals with us. And fourthly, in some ways, maybe equally as important to all of those, is there's a group of folks, like-minded folks, that are providing the same type of debt in the space that we've known for 10 or 15 years outside of cannabis, that are all institutional investors. And we share deals because we're not in a world like in the traditional middle market where one lender provides capital for any solution. You need to be able to put together 2, 3, 4, 5 players. And in every situation that we've been in, we've participated with others. And we like to participate with people that we know, that think the same, that have an institutional mindset, and that do their work. And so they share deals with us as well. And so we've been fortunate that we have a very robust pipeline and continue to see a lot of opportunities.
Perfect, thank you. What happens upon federal legalization? Will every state buy outdoor cannabis from California and crush indoor grows in the Northeast and Midwest?
Unlikely. First off, I mean, I think federal legalization is a ways away, number one. Number two, similar to alcohol, each of the states are going to have a certain set of rules and regulations that are going to need to apply. And it's not clear that they're going to allow cannabis grown in one state to be transported into another state. Ultimately, maybe 10 years from now, maybe 15 years from now, that type of thing will happen, and you'll see large agricultural growers supplying, companies throughout the U.S. and throughout the world. And in fact, those companies may not be in the Northwest. They may be in Latin America. They may be in Colombia or Ecuador. We don't know. But I think we're a long ways away from that happening, and I don't see that on the horizon today.
Thanks, Joel. That does seem to be all the questions that I've pulled through so far. Before we kind of get ready to sign off, is there anything else that you would like to add, Joel?
No, I appreciate everybody's time. I know this is a little bit crazy. It's kind of funny talking to a TV screen and just looking at Lindsay. So I do appreciate everybody's participation and time today. Our contact information is here. I think we'll be sending out some additional information to everybody in the next 24 hours. If you have questions or have an interest, we're happy to answer those, happy to get on the phone with you, and appreciate everybody's time today. Thank you.
Thanks so much, Joel. To all of our attendees, yes, as Joel mentioned, there were a few questions about receiving the deck and some information. So yes, we will be following up with all of you individually. Thank you very much for joining us today, and we hope you have a great day. Thanks, Joel.
Thank you.